Hi, this is Randy Finney with the right side of the chart, and today is Thursday, April 20th, 2023. It's 2:18 p.m. Eastern Time. I'm starting this video, and what we're going to do is a brief look at the equity markets and a few other things too that I wanted to point out. We'll talk about earnings. I'll go over the big names that obviously Tesla's out of the way. That's one of the big market leaders, and we've got a handful more coming up next week. And really concluding with Apple, that's really what the market will have its direction picked. Um, the charts are, haven't changed. My outlook hasn't changed. I'm not looking for a correction. I'm looking for a big drop, 20% plus. Whereas I know most are looking for a continuation of the uptrend. We'll see. I know that there's different views, and even I'm not talking on the site. I'm talking in general, but. This is the EKG we call QQQ. This is that box, the trading range recently we've been in for a while. QQQ has gone nowhere. It peaked right around the beginning of the month here. And so the top of that range, or the box that I have shaded in here, is about 321.55, with the bottom being about 312.72. And there's a sub-range really more recently right here, with the bottom of that being about 315.72 right here. You can see that's contained the trading range for the last few days. And again, it looks like an erratic EKG. Somebody with such an irregular heartbeat, that's usually a precursor to a heart attack or something big. So that's still what I think is going to happen. I think it's going to be earnings season will probably be the catalyst. There's just so much out there, and there's that whole saying, Wall Street climbs a wall of worry. And again, I've talked about it time and time again. The index that I'm focused on, QQQ, has stopped going up over 3 weeks ago now, really beginning of the month, early April, late May or March right there. Anywho, that's it. Not much more to add, but I'm going to show you a few things I haven't showed you today, including one of my volume indicators. But that just watch for that. Here's the MO. You can even see a little bit of a resistance around right here where we capped today. If you take out those last couple spikes, you have a lot of reactions there. So, this is the algos. I have little doubt about it. These are the bots playing a game of ping pong with each other. The bots are automated trading program robots, and it's kind of slang vernacular, and they're just bouncing the cues around, up down, up down, up down. And again, I've said it once, said it a million times. This typically will serve like energy, building up like a coiled spring. And once you have a definitive break in one direction or another, that's likely the catalyst for the next major trend. And if anything, what I've seen in recent days and weeks has only reinforced my views. Again, I'm going to be right or wrong. You guys do what you want to do. I'm still short, with looking to go heavy short once we get some of those next sell signals I'm looking for, including but not limited to a break below the bottom of the trading range there. So that's that 60-minute chart. That's what it looks like. This last pretty much two equal highs, still divergent high. There's the range, there's that sub range I just showed you on the 5-minute chart. Big divergences building, and not just on the 60-minute chart, all the way out to the daily chart here. So QQQ, again, this is what momentum's all about. Yes, it's not going down, but it stopped going up. And again, you can take it as you want. You're an optimist, glass half full, then you're saying that the bears just are, there are not enough sellers out there and every dip is being bought, and that's bullish. Or you can take the other side of it, and again, I'm cited for weeks, if not months now, all the various factors that go in, mostly long-term stuff and evidence that shows most likely this is still a bear market that we're in, and this has all just been a bear market rally. If you're new to the site, my prediction around the time or before this bear market even started is that this one will be much, much different from any in recent memory, really going back about half a century. And so I think that's where you're going to have a lot of the even so-called smart money. No offense, and those people out, I'm sure, listen to my voice that probably work, institutional investors in that business. But I think a lot of those are, we know that to be a fact. A lot are, less experienced and haven't lived through. And I haven't, Yeah, I lived through the bear market of the 70s, probably the closest one, or late 60s to early 70s, but I was just a kid. But I study history. So, anyways, we'll see. Right or wrong, that's my views. And again, there's a lot of long-term indicators that support it. And if we go up much more, then that case starts to be whittled away. I've given you way back when we bottomed, my most likely bounce target zone where this bear market rally would go, and we're still just above the top of that inside of my max potential bounce target zone, where anything much above there, then it makes it a lot harder for me, not just on this daily chart, but it'll flip some indicators on my longer term weekly and monthly charts. So as of now, like I said, I view as a flexible trader, someone that's equally comfortable being long or short any security. I view a rally in a bear trend or bear market, if assuming I'm expecting another leg down. I view that like buying things on sale as far as short selling. If you're looking to buy a car, let's say you're buying, you're buying a Lexus, and the Lexus is $60,000 car. All of a sudden, there's incentives out there and huge incentives, and the dealer has a lot of inventory, and they're going to mark that car down. You can save $10,000 on it. That's a deal. You want to jump on it, and so they hire the fact this rally came up to the high end of where I figured it would, or at least higher end. Makes it all the better. I think these shorts again have a lot of potential, but we'll see. A lot of check marks to be had, and those check marks are more so in price and time. They could come soon. Again, I'm going to get to the earnings here in a second, likely catalyst, but one thing will be a break of this recent trading range. That'll be a big one. Take out the 200, take out the 200-day exponential, the 200-day simple downtrend lines, and really go back to SPY, SPY, the S&P 500, and I'll go to my clean board and just show you that. There's oops, I did not mean to move that line. I was trying to draw an uptrend line right here. I have a lot of different boards, but so SPY already is cracking that right now, that uptrend line there. And remember, I gave that to you on the 60-minute chart of S&P 500 futures. We did trigger a breakdown yesterday. That line was comparable to this minor uptrend line on SPY right here. And now I said, to be safe, a lot of traders, some trade ES, some trade SPY, some don't trade it at all. Some trade NQ, some trade the small caps, mid caps. I'm assuming, those that trade indexes. And you want to see, to be safe, this is a big level to me, still about 411.75 and the trend line right there, and then even bigger when that 406 goes. So again, this is all updates of what I've covered recently. There's the trend line here, the primary trend line that was just broken recently, and my BOD or benefit of the doubt trend line. Both have been broken. We're back testing the second one. So I think this is it. Here's one thing I can tell you. And again, there's no guarantees, but every single day that we extend this trading range on QQQ, we're a day closer to the point where it breaks out. Now, I know that might sound very simple, it's very logical, but that's how it works. And I've done this a long time. No trading range goes sideways forever. So sooner or later, this thing's going to break. Can it break and be a whipsaw and go back into it? Yeah, but usually if this thing is getting long in the twos. I already covered it and compared it to other trading ranges since the bear market started recently. Back in the beginning of 2022, late 2021, and this is one of the longer ranges. And at most, if you get a false break, that'll probably be it, followed by a reversal going the other way. So, all right, let's get to some of the other things. I'm kind of going over what I've covered quite a bit recently. I'm going to talk earnings real quick, and then just a few other things that I'm watching, including a volume indicator that says this may be the end, and that is the end of the rally, or the beginning of the drop. All right, earnings, the big fangs in this order. Okay, so here's what we have on deck for next week, Tuesday. Remember, all of these tech companies, they report after the market closes, all the ones I'm about to mention. Microsoft, let's just look at the daily chart. Back to my main board here. Very clean, unmistakable negative divergence, divergent high right here, divergence building. Give me my drawing line tool, there it is. negative divergence into the recent high. It's comparable little trading range right there sideways, and some price support below. So lights out for Microsoft down that way. No guarantees, but I've said this often. And an earnings report, as far as holding a position, whether you're long or short, if you have any position, or which way the stock may go, to me is a coin toss, unless the charts are clearly bullish and bearish, or bearish. I'm sorry, I'm trying to talk fast here and get all this out. So if a chart has a clearly bearish technical posture, and my definition of a bearish chart might not be, and probably isn't most people's definition. I guarantee you the majority of investors, traders, we're going to say this is a very bullish chart. You have a stock that has since November clearly in an unmistakable, irrefutable uptrend, right at the top of that uptrend. So most investors, and I get it from that perspective, yes, bullish, but I'm looking, I named the right side of the chart for a reason. Anything, there's the current level where prices are, you can, put your line like this, and, anything to the right is in the future. And so I tried to predict. It does no good to sit here and tell you that Microsoft's in an uptrend and the trend's bullish. If you want to buy, if you're a trend chaser, yeah, then you do that and you buy pullbacks to support, and that works until it doesn't work. But usually those trend chasers, especially in a bear market, have their lunch eaten, because they start buying dips, buying dips until they realize all the way down here that the trend has changed. And usually when a bear market rally is over, they don't let you out. If you didn't get out early and you didn't have your stops in place, or you didn't turn around and short, the downs are pretty hard in a bear market, and I expect nothing less this time around. There is a lot of hot air in this market, in my opinion, and a lot of red flags, namely these handful, again, I've commented on this weeks ago, a couple, even maybe a month or two back. This is the kind of insanity, in my opinion. This is just me, that I've seen a lot in my career in trading and investing, but what I've seen so far this year is some of the more risky stocks. They are the big tech companies. They are earnings juggernauts. They're what you want to own in a growth environment. They're what you wanted to own for the last 20 years. But I'm talking about Microsoft, Amazon, Alphabet, even Tesla. These high growth companies have actually, for some weird reason, I have some theories, become flight to safety instruments. In other words, market breadth has continued to deteriorate. You look at the rally off the lows, and the vast majority, and this has been documented, this is just my opinion, as you can see it, and you can look at the equal weighted indexes and things like that, and it's just been almost the vast majority of the returns are associated with, or the result of just those big handful, again, top half dozen or so, 7, 8 companies in the S&P, NASDAQ 100, Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, Meta, Broadcom, and those names. And why I say they have been treated as a flight to safety asset is during the most recent financial crisis, which was the banks. First it was crypto, then it was the regional banks, and it was one of the biggest banks in the world, Credit Suisse. So we've seen that progression, but that's where you continue to see money flowing into these guys as if they were some type of treasury bonds or something. And that, to me, it's a dangerous thing. Valuations are nosebleed high levels right now, and so. Hey, yeah, you know what? I'm sure there are folks out there, and I've heard it, making a case why these guys can just keep going up. And I understand the money that they have on hand to do stock buybacks and all that. But I've been doing this a long time. They were doing stock buybacks in 2008, 2007, and they just kept going down. So, anywho, that's what I see. I see dangerous market conditions. Those, the divergence between the rest of the stock market and just a handful is a very unhealthy sign. It is not a healthy sign of a rally. And so that's that. So I'm just going to go over these again, move into a few other things here, but that's Microsoft first. Then we have that's on Tuesday after the market closes. Meta. Meta yesterday, I told you, triggered a sell signal, and you can take that if you want as one of the earlier. That's on a breakdown mode now, down again today. But they do report. Keep in mind, you take a risk. Any trade you take, you have a risk. Especially as a swing trader, you have overnight risk. Anything can happen, but you have additional risk when you go into earnings because this can go either way. And just because I've said it's my experience that a chart that is clearly has a clearly bullish or a clearly bearish technical posture heading into earnings, more often than not, that's the way the stock goes. I care very little about the initial reaction, and in fact, it's been my history that usually it's very, very common to see a post-market pop in one of these big tech companies. They almost always report. Apple's, certainly has a record of this. Quarter after quarter is a record. It's just like when Tim Cook parades out on stage for the new introduction. This is the best iPhone ever, the fastest. Well, of course. But anyways, with their earnings, it's usually Groundhog Day or the same thing over. They report a record quarter and this and that and other, and everyone takes apart the report. And what I was going to say is, quite often you'll get an initial pop, and only to see that faded. And I'm talking, this is not on daily here. Yes, sometimes you'll see it carried in the next day. So I just want to clarify when I say that these charts that I'm pointing out, that to me, although these stocks are at very near 52-week highs. They, especially this one's already on a sell signal. Then you can see if you do get a pop in Meta. Let me just show you and tell you something here. So this is my primary bear market downtrend line. Meta peaked back in September, early September of 2021. There's the downtrend line. We're very close. We haven't hit it yet. Usually when you have a clean, well-defined trend line like that and you get that close, it's like a magnet. Prices hit it. So it wouldn't surprise me one bit to see Meta pop up after, only to see it tag that, make a full tag of the trend line, maybe a little whipsaw back above the line, only to see then a hard reversal after that. But this is my kind of chart. I will take these trades all day long and not look back if I'm stopped out or wrong. If I take this trade, this kind of setup, one of my favorite patterns, bearish rising wedge, especially in a primary bear market with extreme overbought conditions and clear negative divergence. I don't know the numbers, guys, because that depends on market conditions. It depends on the individual security, even the asset class. Some things have more whipsaws than others. But I would say a good 8 times out of 10, that's going to pan out for me. So, the old saying goes, you miss 100% of the shots never taken. And so therefore, these patterns are so clearly bearish to me that so I've been telling you for weeks now, I'm short and plan to get even shorter, if that's proper vernacular, once I get the additional sell signals I'm looking for. So Meta, just mark your calendars or keep a mental note. They're all next week, and then Apple's the following week. But Meta's Wednesday after the close. Then on Thursday, you have Amazon. Amazon at this downtrend line right now, struggling with that. I recall a couple of these guys since this bear market has started, popping some resistance levels. In other words, breaking out shortly before earnings. I'll say this, I put very little into a stock that breaks out, whether it's a bullish breakout or a bearish breakdown, just before earnings. Take that breakout with a grain of salt. Now, maybe the breakout that sticks, but quite often it isn't. Again, earnings are going to change. They are a strong fundamental force that has the potential to override the technicals. So all I can tell you is Amazon is in a clear, unmistakable bear market downtrend. Nobody can argue that. It's not even debatable when you look at the charts. With the stock peaking here and the lower lows and the higher highs, there's a downtrend line, and there's your 200-day moving averages right above it. I don't know if you can see them on my chart. The red and blue lines are pinched together, and those 200s have capped all the major rallies on Amazon. So, I always use those court of law analogies, innocent until proven guilty. Well, this one's in a bear trend until proven otherwise. It's not even, some of the others at least have taken out their 200s or taken out some downtrend lines, and those I think will fail. But that's it. So we've got some pretty ugly looking charts here, and we're heading into earnings. There's a island reversal candle. All right, what else do we have? Intel, not the biggest semi anymore. It's down the line, but they report as well. This one a few months back was one of my favorite. We hit both targets, even took out that trading range there. Ran up. Last update I gave you was at that first next target if it broke the range 33.32. Still has this potential downtrend line if it can carry on. Let's say the market holds up. In other words, it's unlikely if we're about to take that next big leg down like I think we are, double digits, 20+%, maybe 30%. In the Qs, it is very unlikely Intel, no matter how bullish the report is, will go on and hit that. It is possible. Intel kind of bucked the trend, and Intel topped a long time before the market did and was in a downtrend while the rest of the semis were going up. So it can do its own thing. And that was, again, still is the of the semis, the single most bullish, the big semis, that are out there. Single most bullish chart pattern I've seen with both on the weekly and the daily. That big trading range, W bottom, breakout, and it's back testing the top of the range. So I guess what I'm trying to say is I don't have a position in Intel now. If I had to put a gun to my head, I had to be long or short. Probably long, and maybe even do that. It's not a bad idea to maybe hedge. I'm still short the semis. I'll get to those in a second. That's what this was for me before too, if you recall. Taking that against both a pure play long and a hedge. But anywho, that's Intel. I just want to mention that they do report. Along with, I'm not covering each and every company. There's the big ones. All the big semis are also reporting over the next week or two. Friday, I just want to bring this up. Friday morning, you have XLE reporting. Being a little facetious, XLE is the energy ETF. I give that as a short trade. What's been on and off. We had trades throughout the all the way back here. T1 hit, T2, T3 recently hit, T4, T5. It is still an active long-term swing trade from back here. I've talked on that many times. And I want to just show you that we have this basically a back test right here. You have an uptrend line right there, primary uptrend line, breakdown that hit T3 recently in back testing. And I still maintain these targets here, T4, T5, and T6 zone. That's a lot of downside left in energy. Why did I say XLE is reporting? ETFs do not report earnings? Well, because Chevron and ExxonMobil are almost the entire ETF. They make up well over 50%, just those two. So it doesn't matter where the rest go. And those guys report on Friday before the market opens. That's XOM. Same thing. Primary uptrend line off the October 2020 lows right there. Nice and clean uptrend line. Breakdown, back test. Little consolidation range, just like QQQ, right? It's no coincidence this chart is nearly identical to XLE. I just wanted to say that's in a bearish technical posture. It's already broke down, back tested once, went up, made another back test, and PPO is poised to make a bearish crossover. That was a major divergent high. I could go on and on and on, but that's where I think the energy stocks are going down. CVX, Chevron, same trend line off the 20 earlier, the COVID lows. Beautiful trend line, 2, 3, almost we'll call that 4 or 5, 6 reactions, then broke down, back tested, hit this support / target zone right here, bounce, back testing. If you miss a breakdown, you get it on the back test. All right, no guarantees. You can set your stops wherever you want, depending on where you think it's going. Big old divergent high right there in this stock. The next stop, we already checked that first target support zone right there at about 150-ish. So maybe another reaction, maybe not. I wouldn't bank on it because it's already been hit once. So this one, just so you know, I have about 25% downside to my next target there. It's about 127.65. Okie doke. And then the big one, big dog, Apple. Apple likes to bring it home, and that's the last of the big market leading things to report. It's going to be March 4th, Thursday after the market closes. I've covered this one a lot lately. One of my favorite. This is the most bearish setup I've seen on Apple in years. at least since the market peaked right there, because it's the last time we've had, that was the last time we had negative divergence on the daily chart. You have the stock in a confirmed downtrend. There's your bear market downtrend line. Been rejected each and every time we hit that bear market downtrend line. And you also have a beautiful uptrend line below and beautiful negative divergences. I know I speak of I'm a geek. I talk charts like a art enthusiast, but that's what I see. I see a lot in this chart. Now, doesn't guarantee I'm going to be right. Doesn't guarantee it's going to play out. Maybe we pop up, fake out. That'd be a big stop clearing move, suck in a lot of bulls. So if that happens, they break that trend line, whether it's a day, 3 days, a week, 3 weeks, watch this uptrend line, because that is your sell signal. There are two objective ways, in my opinion, to short a stock. One is in a downtrend, a rally into resistance, or a break below support. Now again, any position in Apple, even in QQQNQ, there's risk that Apple can blow the cover off the ball. Again, that's what they are. They're an earnings juggernaut. They are the world's not the world's most profitable company. But don't ever, if you're new to this, don't ever confuse a bullish earnings report, bullish guidance. Trust in the market's reaction, or wait for the market's reaction. Because if Apple, and they could have a bad report, don't get me wrong. I'm not saying that every report's going to blow away earnings and be, record earnings and all that good stuff, and, check boxes in every bit, every metric that the analysts are looking for. But if you are bullish on Apple, again, great company, you need to ask yourself how much of the, I'm measuring from right here, from the beginning, the January lows, and that's when I was bullish and long, clearly on the site, Apple. How much of that 35% rally, just since the start of the year, how much of that has been priced into whatever they're about to report next week or the following week? So anyways, that's what happens. So sometimes, and quite often in the stock market, it's a buy the rumor, right? Meaning little birdies whispering in hedge fund managers' ears, pension funds and all that. Buy the rumor, sell the news. All right. So that's why stocks, and Apple's notorious for peaking on major earnings report. I highlighted back here, 1028 post earnings popped hard after earnings. And on the evening of October 27th, and that was right there, and never looked back. From that point, if you bought that earnings pop, and there was the rosy earnings, and I think guidance too was good, you then were followed by a 21% drop over the next couple of months. So, and I've seen that time and time again at Apple. And again, I'm not trying to imply that every earnings report is going to be positive and everyone's going to get sold. What I am trying to say is the technicals point to whether we get a post-earnings pop or not. I'm looking for a drop based on the technicals, and it's not an all-in or aggressive moment in Apple nor the QQQs until this level is clearly taken out. My guess, based on the technicals and the number of things that are going to report before Apple, they have the potential to start turning the market. This trading range again is getting long in the tooth. And if they do, remember, Apple is a top component of these indexes, and it's all about the money flowing in and out of the indexes at this point. And so that would probably bring Apple down in sympathy, just like Tesla's brought a lot of those guys down today, with Apple being down 0.74%. All right, that's that. And we know what happened to Tesla. Tesla's down 10%. Here's a stock. Again, you do not have to be a skilled market technician to look at this chart with a company that peaked back in November 2021 and has clearly been making a series of lower highs and lower lows. Certainly one could make the case that that was the end, that is just a correction and pullback, and bulls, that's, I don't know, this is, yeah, there's a gap right there. You can make a case to step in. But if and when this stock goes on to take out those January lows, it'll be, confirmation that the bear market is still well underway and intact. Okay, told you I have a few new things. A lot of that was a recap that I just gave you if you've been keeping up with my analysis. The other thing is one of many, many indicators or technicals I look at is volume. I've had over the years many different type of volume indicators of volume reaching certain levels, look for volume confirming rallies. It's gotten tougher in the past, in my opinion, the past 15, 20 years than it used to be, with a lot of, the majority of volume now is done by institutional trading programs, high frequency trading and algos and things like that. But with that being said, I've noticed patterns, and not just, well, there was one recently. So over time, I'm going to tell you my levels change. The one thing I do is I'm constantly looking and seeing, do I need to tweak my indicators? Do I need to tweak certain moving averages, certain indicators, whether volume indicators? And I'm a firm believer, and that's why over the years, believe me, in the past I dabbled with those automated trading systems, where you can go into these programs. You're right. Okay, if you get a bullish crossover and it's above, the stock is above the 50-day moving average, and you enter all the criterias, and then the program will buy and sell, and you back test those things, and it's like, oh man, this program's great. It's analyzing, 50% a year, and it's got a 90% success rate, blah blah blah. The minute you start to use it, it stops working. And why is that? And why did I quickly, not quickly, I dabbled with them for a while, but never really went full in. I just learned that back testing looks great, it works, and it's showing you the past. And market conditions change on any given stock, any security. If you've got a great automated trading system that works, do yourself a favor. Don't tell anyone. Keep doing it. Turn around. Why? Well, go out and sail a boat. Go travel around the world. Let your computer trade for itself. I'm just I don't believe it's a thing, because again, you have to have, maybe, with this advent of AI and adaptive, things can get smarter and start to recognize, or more importantly, anticipate future market conditions. That's one thing, and I think a takeaway from the site that I think I provide is not just identifying, telling you, hey, guess what, we're in a trading range. Anybody now can realize that and QQQ, but it quite often I've been able to kind of predict when there's going to be a sharp move, a breakout, and a strong rally or drop or an inflection point in the market, or in the past, when we might run into, and I didn't really anticipate this one would go so long, but in the past I've anticipated some of these choppy trading ranges. And then the takeaway is, if you anticipate it, you can either disengage the market, or at least that particular security, or at least not become frustrated. Or there's also trading strategies, selling premium, on options. There's a lot of things you can do to profit in a trading range. But what I wanted to show you here is that right now, let's look at volume. What I've noticed since the bear market started, or really actually about halfway underway, or at least most recently, that's what I'm looking at. I always put the highest weighting on any analysis, whether it's a trend line, price support, resistance levels. Let's say key moving average, like the 200 days. There's some stocks, or sometimes the indexes are working perfectly, bouncing off those support and resistance. And then there's times, if I notice a stock or an index that starts slicing through the 200-day or 50-day or 100-day, whatever it is you're using, like it's not even there. Well, guess what? Quit using that. It's not, at least at that point in time, that's not useful. And it doesn't matter for 20 years if that stock behaved, quote unquote, very well off the 200 by bouncing, when it hit it. If it's not doing it recently, move on. Wait till you see that pattern resume. So the volume pattern, when the bear market started, you had a lot of money coming out, volume spike. Volume will almost always spike on big down moves. So that's common. That's not, I wouldn't call that a confirmation of the downtrend. People do look for volume to confirm a move, but it's sort of normalized from that point. And what I do is, in this case, I have a 10-day exponential moving average on volume. That's the blue line here. See, these the red lines here are my low volume indicators. Usually when they get down here in a bull trend in the past, that's what I've used, and usually, and I've spotted these out. These are all things I've shared on the site in the past. I had these levels, red and yellow, and you hit them, you get there, and then the corrections follow. This one, we nailed it right there. We had an extended period of low volume, and it's usually once you cross back up and the volume then starts picking up, and that caught the 2020 COVID drop there. Again, you can see a lot of corrections. All the arrows are there. So it's and again, that was back then. That was in a bull market. Well, guess what? We're no longer in a bull market. Volume has been high and remains high. We're nowhere even close to those. I'm talking again the 10-day moving average. So I'm not looking for any move down to these lines, because those were to help me anticipate sell signals or corrections in an ongoing bull market. We're in a bear market now, so I'm looking at a different level, and I'm looking so far. I will admit it doesn't have a super long track record, but since about last summer, it was when you had a rally. You can see here when the market was in clear rally mode and volume hit this line right here on it doesn't matter what it is. It looks to be, I could put the number up, about 40 something million shares, but that's what did the trick, right? QQQ hit that level, and that was it. Lights out, rally over, next drop came. We had a rally here. There, remember the market bottom in October, rallied all the way up to here, and we tagged it right there. We had a little check, volume bounce, then we hit it one more time, so it's what I call a double tap. We had a double tap on that volume level, and then a boom. That was a drop of 12% right there, and we stayed clear of it there. We are also coming off correction. You want to look for this, by the way. We already fell to it after you've had a rally, and so since we rallied, since we bottomed back in the beginning of the year, since the market started rallying, this is the first drop, or close, almost right. You can really split hairs, hair above it, but very, very close to that level. Close enough to say, hey, there's been a precipitous drop in volume right here. And this confirms with everything I've been telling you about this trading range. Again, glass half full, folks. Bullish are saying, yep, buy the dip. That's what this is going on. The market refuses to go down. Doesn't matter how bearish the fundamentals are, they're buying. No, the momentum has waned. In fact, the Qs, as I pointed out, stopped going up at the beginning of the month, and they're still below that level. Battle's not won yet, but you can also see that in this trading range, volume's been falling off like a cliff, falling off sharply, and that is a sign of non-confirmation. So my read is, that's just the last of the bears covering. The algos are playing, ping pong with each other, but there's no buying going on here. Institutions aren't buying anymore in that range. Maybe they will buy. Look, guys, if we break out, if earnings seasons they blow it out, and we start moving away from there, it's going to be very hard for me to continue to make a bearish case. Not right away, but it's incremental. We still have, divergences. Maybe you get a little false breakout. But if we power on through there, then that's going to, again, be, especially if we take out the top of my max bounce target range, which is really this reaction high in QQQ, then it really gets, it chips away at the longer term bearish case, because at that point I'm going to have some of my longer term indicators flip from bearish to bullish, and I'll do my best to convey my thoughts if and when that, as that happens, if it happens. As of now, this is what I think will happen. And we'll look at a few more. Let's look at stocks, semis. Nope, SOXX. There we go. Okay. This is the beginning of 2022 right here. This is the day right there. That's when the bear market began for the semis, or the last bull market ended. Obviously, we've been in a downtrend since then. Some would say we're certainly in an uptrend since October, like the stock market off the October lows. However, there is a level that seems to be the magic number right here since the bear market started, and that is a drop to this level here at about 70. What is that? 7 million or 700,000 or so in volume. 775 down there, whatever the line is, and you can see we tagged it there. And that cap came right after that rally peaked, started rolling over. We hit that level there, and you had the next leg down in the bear market. Then you had a nice strong rally here. Volume was good, increasing. They were buying, but they started to stop. The volume started tapering off towards the end there, and then boom, purple lines show where we hit that level. So you can I don't have to explain the rest. You can see rally, tag of the level right there, right before the top came. Next big correction, hit it right there, had a little bit of a correction, went up, but you can see momentum has slowed significantly. This high here was only a marginal new high over that one. So admittedly, I've been early on the semiconductor short trade, but not wrong. I differentiate. This is just me. I have two terms. Being early on a trade is exactly that. You entered early, you don't hit your price targets for a while, as long as you don't exceed your stop parameters. If you're stopped out, you've taken a loss, you are wrong. There's no way to spin that. Say wrong for the right reasons, wrong for the wrong reasons, doesn't matter. So if you're early, as long as you don't get stopped out, and again, based on where we shorted, this one's not even close to being stopped out, and might even still be profitable right now. I'll get to the chart in a second. I just want to say that, look, we just hit that level again, so that's it. And then last but not least, before I run into one other thing, I want to just hit the financials real quick. Talk about the VIX, and you can see, remember back here, pointed out we had a divergent low, i.e. positive divergence, with the indicators making, both the RSI and PPO making higher lows and prices making lower lows. That was a divergent low. From there, it's not as if that divergence didn't play out. It did cause a trend reversal in the VIX and a correction in the market. And that was the VIX rallied roughly 80% right there off that divergent low. And we did take out, I was highlighting this trend line because we were also at that trend line before. That's this uptrend line here. It's not my line tool. This is my line tool. Trend line, but you can see these are support levels that I've had on this chart forever. Let's see, this one, 1673, created that back in November of 2018, and this one here, so it's a support zone, 1573, the horizontal line I'm talking about, that was created back also in 2018, and you can see it's really been since this period leading up to COVID, the COVID lows, this was the lows. This was our support zone, the bottom. This is where you wanted to buy volatility, buy the VIX, or in conjunction with breakdowns in the market to trade corrections. And then we set a new floor. We've had and continue to have a new floor in the VIX since then. Now, we're not all the way down to the bottom of that support zone, but what I can tell you is that we are at the top of it, and we do have the same divergence that was in place before is even larger now. So should this play out, and that would almost certainly coincide with a breakdown, those next sell signals I'm looking for on QQQ and SPY, then we could rally. And we had an 80% rally off this smaller divergent low. If this one plays out, we'll probably go on to hit those higher targets that I have up there. So the VIX has, given the right conditions, market breaking down, and if I'm right on the 20-30% drop in QQQ from where we're at, you're talking maybe a double in the VIX. It could easily go up 200%. Right now, there's no buy signals on it, but other than you are at support. So that's the VIX. And then last but not least, let me just give a quick update on the financials for you. All right, so this is XLF. Let me just look at the weekly for you. I've got a lot of lines here, and there's one trend line there. It's at major support on a trend line, but let me look at I want to look at the individual stocks before I leave the sector ETF. Remember, this was also trade back here. T1 hit. We never exceeded the stop relative to the third and final target. We hit that third target there. We bounce. We hit it again. We bounce. And we just hit it again. That now has become very significant support. It was significant enough back then for me to list that as my final target. Final targets I usually list where I think the end of a trend will happen, and that's where you want to buy, cover, and maybe go long. But the fact, if it was good support for me then, it's even much better support now. So all I'm trying to say is watch that. That is lights out for the market. It will be a very ominous sign for the banks and the financial sector if and when that goes. There's a minor uptrend line there. Trend indicator, PPO is still below the zero line. Typically when you are, the PPO is above the zero line, the trend's bullish. When it's below, the trend is bearish. So I just want to point that out. And then looking at the big names, Visa is now the largest at 480 billion. And you can see this one, another chart that's quite bearish in my opinion. Big resistance level there, about 236.50 or so. You had a divergent high right there, and you had a correction. You push back up to make a marginal new but still even larger divergent high, and you have a nice clean uptrend line in which to trigger a sell signal. So if I don't have an alert, I don't think I do on this one, so I'm going to set an alert, and you can see right there. So keep an eye on that, because again, this is the largest, even larger than JP Morgan now, at least according to my charting platform. It tells me JP Morgan second at 414 billion. JP Morgan put in a divergent high there, gave a sell signal on the break of that uptrend line, and it's rallied back to a level. I've had this resistance level here for a while. Based on my long-term chart, JP Morgan is in a bear market with a lot more downside to come. This is the bull market uptrend line. This is the 2009 lows. So that's the 08 banking. Last time we had a banking crisis back then, 2008. That was our primary uptrend line, nice and clean. We broke it in 2018. I'm sorry, 2020 when COVID hit. Again, COVID to me was not, at least for the stock market, wasn't a random event. COVID was certainly a black swan by those, every other metric. But we had big divergences. The market was looking for in my opinion, the end of the bear market and a start of a new end of the bull market and a start of a new bear market. And we got that. It was JP Morgan dropped 46%, the S&P dropped 36%, but it's what I dubbed or named the Ursa Interruptus, bear market interrupted by the Fed and the federal government, which would not allow it, and came in with just some crazy excessive stimulus that kind of foiled and just delayed the inevitable. So it took us back above the trend line, but then the trend line once again broke here after another divergent high, and so this is it. So this is just really a continuation of the bear market that again should have started there, but officially started right there. And so this is where I think JP Morgan goes. I just want to give you my big picture there. Look at all the financial. These are the trend lines. That's a major secular bull market, and nice, beautiful uptrend line. And Mastercard broke it there, and it's been moving sideways on a big support shelf though. So we're quite a bit above it now, but 285, 87, just like the stock market. Remember the S&P did this, kind of topped, it goes up, and just like QQQ is doing now in a much smaller time frame, the 60-minute chart, that's just the market's run out of buyers, and the stock has, and it's been what, 2 years since early 2020 since it's been in this trading range, and we're far from it now. We're closer to the top than the bottom, but when that goes, that's going to be ugly. And based on the big divergences and the fact we're below the primary trend line, I think it will ultimately go. But what you do there, you can't really position on that long-term chart. It can help formulate, your longer-term outlook. But what you need to make a case to short Mastercard is a break of this minor uptrend line right there. That's your first sell signal. Then a break of these recent lows, and so forth and so on. Berkshire. I'm not going to go through each and every one, guys. I know this video is going longer than usual, but there's a big negative divergence, or big divergent high. We had a divergent high right here in Berkshire. At this point, that was a divergent high. The stock from there corrected. Let me just grab. It was a 9% drop. The divergence now is much bigger. And back then, oh yeah, we had a little minor trend line. Look, there was your sell signal on that little minor trend line break to get in. And now you have one right there. So it's simple as this. Zoom in, let's tighten it up. We're right on it, set an alert. And then boom, that's going to be your sell signal. And by the way, these are actionable trade ideas. This one, I think it's an objective short entry for a swing. I would at minimum target that 293 level we already hit. You're talking about another 9% drop in Berkshire. And being that divergent high now is even bigger and larger than it was back at the last time we dropped that much, most likely will carry down to at least that second or third target down there. But again, I'm just giving you a bigger picture, and a lot of these are below trend, their primary trend lines, and look to be in bear market rallies. There's Bank of America, stair stepping lower, turn off all the lines. This is what a downtrend looks like, and and you have these little micro uptrends and some of the larger downtrends. But just going to go over a few more. Wells Fargo, ooh, that's a nice looking short right here. Look at that. Objective. Can't promise it'll play out, but I promise it's objective. There's an uptrend line. You got a breakdown and a back test and price resistance. Nice price resistance. So you can short a WFC right here with a stop not too far above. You got your 200-day moving averages as well. You know, relatively tight stop compared to the profit potential. I would target nothing less than at $34 right there. That's 33.78 is where my support is, so maybe cover a little bit above that. That's a 20% drop. So you could give yourself a 10% stop loss. That's a 2-to-1 RR, or you could even go tighter. Give yourself a 3%. I'm sorry, a 7% stop loss, and you have a nice 3-to-1 RR roughly. Morgan Stanley needs to crack that trend line. That would be the uptrend line sell signal there for you. AXP flirting with it, tried to break it today. They came in and gave it a little stick safe so far, but a break of this uptrend line, because we're right on it right now, that'll take you down. I'll give you a sell signal on AXP. So I'm just giving you a brief overview of the financial sector, because I have that feeling that the market thinks that they dodged a bullet. Fed cavalry came riding in to save the day. Island top right there in SPGI, S&P Global, and that's a major topping stick. And so far this looks like just a kickback rally with another leg down to come. GS, Goldman Sachs at trendline resistance, so one could make a case to short here at trendline resistance and or on a break below this little wedge type price channel. And then your first target is going to be this uptrend line, which I think will get broken. That will be your next objective add-on or short sell signal, and that should take us down to about that 270.80 target. I'm going to wrap up here. Oh, Schwab reminds me the other one I wanted to show you, and then we will wrap up. Super long video, but hopefully you guys can take some trade ideas or useful info from this. IAI, broker dealer index. Remember, I highlighted this one a couple. I've been highlighting it pretty much for all year. We had a beautiful, there's my favorite pattern, a little bearish rising wedge, negative divergences, trend line break, sell signal, highlighted, I believe highlighted at the time, good for a 16% drop. And what that also did is it took out this uptrend line right here. So the broker dealers are also an objective short entry. That's a breakdown, back test, and then boom. Probably a lot of upside, especially when you take a look at the long-term charts. This is a weekly chart, big divergent high, and I'll just end the video by saying this. A lot of these charts, and I've done this in the past, not so much in this video. You go back to when I go to my weekly and my monthly charts, I see a lot of stocks, especially those and sectors that held up relatively well in the bear market so far, have beautiful secular bull market uptrend lines, which in my opinion are magnets. Number one, I believe we're in a bear market with more to come. If I'm right, then a very likely target are these uptrend lines, and that would still keep it. By the way, you might say, Randy, you're crazy. You're so bearish. You think the broker dealer sector is going to drop almost 50% from the highs? Yeah, I do, and from where we're at now, I think that's already started. It started with that divergent high, and from where we're at now, depending if when we get there, I think it'll be pretty quick. It's about another 35% downside. And so, I've already gone over a lot of the individual in other videos. If you're new to the site, or if you're not aware of this, under this post, I tag every time I do a video, every symbol, every ticker, trade idea I cover, it's in there as a symbol tag. So if you click IAI, it'll then load all the previous and recent videos and or static charts that I've posted on the site, so you can then, if you're looking for individual trade ideas within there, like NASDAQ or ICE or CME, you'll see all the charts that I covered before, and you can replicate those and see where we're at. All right, I got to wrap it up here, guys. This has been Randy Finney with Right Side of the Chart. Have a great day.